Nandini, how do you manage risk? How do you price it?
Yeah, well, I think it's finding the right asset allocation that works, that balances the biggest risk. And for us, one of the biggest risks coming up in the next few quarters, the next few years, is the weakness that we expect central government bonds to face. So whether that's gilts, treasuries, Eurozone sovereign bonds, that's where we find the most risk and potential for downside. And just moving slightly away from there, finding other fixed income-like securities or securities that don't have that much interest rate or duration risk is one of the big plays for us. I mean, broadly as well, noting that valuations are quite high in certain equity markets. It's again finding some of the more value-oriented or cheaper sectors that still have fundamentals that can back them up, so you're not buying the whole index but being a bit more selective in the equity market as well.
Well, fair point. And Emad, when you talk to somebody about why they're going to be buying equities in the middle of all this risk, they say, hey, the earnings fundamentals and earnings growth are really strong. Where is there more juice for it to be stronger, and where is that growth fully reflected?
Yeah, I mean, I think this year you've seen the first year of real synchronized global growth in many, many years, especially in emerging markets starting to come through after a prolonged period of pause. Eurozone really kicking on. I think Nandini was completely correct in terms of most of the danger seems to be more on the fixed income side in terms of just the path that we can see in terms of quantitative tightening perhaps and then to some of these asset purchases. But for equities, the story actually looks quite positive, especially if bonds don't blow out completely, which is difficult for them to do given where interest rates can really go.
But does that mean, as a practical matter, Emad, that we really are hostage to the central banks, and particularly the ECB? I mean, if you start to have quantitative tightening there, because it would be the second central bank, what might that do to the yields and therefore the interest costs?
Well, I mean, this is the thing. The yields will go up, interest costs could go up. I mean, you could easily see a 3.5 on US 10-year bonds, for example. But that isn't actually that much. You're not going to have a typical classical cycle where you go back up to 3, 4, 5% interest rates because the governments can't actually afford those. If you kind of look at the Japanese JJBs and kind of the potential interest costs, even the US adding an extra $10 trillion of debt, you are capped as to where interest rates can go within this cycle. And so I think you get maybe a bit of a shakeout, but then everything is relative and asset allocators have to allocate, and it becomes very difficult for them to do so, which is why you might get a fundamental-led squeeze followed by just a we can't really buy anything else squeeze.